And pretty quickly we realized, okay, we got to be innovative here. We got to come up with something unique and different. When we did that, something unique happened. We actually positioned ourselves as a leader in that space, and it became, the time was PC Magazine's top 100 website as well.
I'm your host, Jason Raznick, founder of Benzinga, a leading platform in the financial world with the mission to level the playing field for individual investors. And this is the Raz Report podcast, where we share inspiring stories, expert advice, and exclusive perspectives to keep you ahead of the ever-changing world of investments and entrepreneurship. Let's dive into the show.
All right. Excited for this week's edition of the Raz Report. If you ever want to learn how to grow a startup, take an idea from just an idea to execution, we have the guy for you, Colin Campbell, owner and managing director of Startup Club, who's been involved with many different startups, a serial entrepreneur, author of Start, Scale, Exit, Repeat. This is a book he's written, and you can learn. It's a bestseller on Amazon. I mean, what haven't you done, sir?
I mean, it's been quite a lot. Over 30 years as a serial entrepreneur.
I mean, yeah, almost $1 billion in internet companies that you founded and scaled, and navigated exits of, right? Is that pretty much?
That's right. Yeah, yes, and it wasn't all uphill either. There was some pretty big flameouts along the way, and we learned a lot of lessons. Let me just tell you that.
Yeah, and I want to hear some of the flameouts and some of the lessons. But one of the ones that I recall being really big at times and going through different gyrations, the domain got 2 cows. What'd you do with 2 cows?
Yeah, so we started that in the mid 90s. It was a gentleman out of Flint, Michigan who was a librarian who wanted to get his software put online. And he came to us and we put it online. And
how did he find you?
First day it took. He was looking for a provider that he could host his site on.
Were you Hostopia then?
No, we were Internet Direct. So we had a large network, data network. And we put it online, and within the first day, it took down our network. And pretty quickly, we realized, okay, we got to be innovative here. We got to come up with something unique and different way of doing this. So our tech team designed a mirror system and started mirroring 2 cows all over the globe. And when we did that, something unique happened. We actually positioned ourselves as a leader in that space, and it became the time was PC Magazine's top 100 website as well.
Wow. So you basically you started mirroring the site. I'm assuming that's not akin to what Akamai did with caching, right? Or was it sort of?
That's similar. Yeah, it is a bit similar to that. If you're getting a little technical. I'm not a technical person. It was my brother at the time who was more technical than myself. But what it did is it gave us global distribution. At the time, service providers didn't want to pay for internet, so you would host the data locally, and then they could download it, and we would just simply every day we would do an update, and it would mirror that software. But the side effect was it became a global sort of website for downloading web software.
100%. Did you get involved with it? Did you become an equity owner? Did you guys invest in it?
Yeah, so at the time we brought them on, it took our systems down. We invested hundreds of thousands of dollars in the company, and we brought Scott Sikorsky in to our company, and it was called, we renamed it 2 Cows Interactive, and we did that. We did we did web hosting, we did domain names, we did a lot of different things down the road. Today it's actually known as more of a domain name company and also a small telecom. Interestingly enough,
didn't it go public?
Interesting enough, the gentleman that I hired to run 2 Cows is still the CEO today.
Really?
And his name's Elliot Nass, and he's done phenomenal with the company. He was a pain in the ass. Let me tell you this.
Why?
Never fought with somebody more than I did with him. But that's one of the things we talk about in the book, Start, Scale, Exit, Repeat, is you don't always want to hire the naysayers. You want leaders around you that are going to challenge you and be difficult, but also deliver results. And he was one of those leaders that did that. And he's been very successful with the company since we sold it.
That's interesting. So you're saying it's okay to find leaders that are difficult, but as long as they deliver results, then you're good.
Well, no, to be clear here, a lot of leaders they fail to scale because they hire yes people around them. When you hire people who are going to challenge you, who are going to, take the initiative to bring deals in on their own, where you're not pushing them forward, it takes a lot less energy to pull someone back than it does to push them forward. And if you have a leader in your team and you feel like you're always pushing them, then you're more likely than not, you need to think about getting a new leader.
Right. Yeah. No, I mean, we sold private equity end of 2021, brought on a CEO about, I don't know, a few months ago. And I founded the company. So I took a step back, exec chair. And you're right. Like, it's not going to be the same way that, what I've made obviously a lot of mistakes in building the company. No, anytime you do anything, you're either making a mistake or you're doing it right. And so what I want to do is like just share the mistakes I made, like signing a contract with, versus like, hey, can we get this not in a 3-year contract? Can we do a 6-month trial? Just like those are like some things that the war stories that I have, because we host events too. I like to share those, but you're right. Someone else who comes in is going to do it their way. And then all you want to do is support them and hope they deliver the results.
And coach them.
Right?
And coach them. Yeah. And there's a lot of systems when it comes to scaling. You brought up an interesting point about stepping back there, but the number one reason why companies fail to scale is the entrepreneur themselves. And because they really, I think of my own career when I was 36 years old, we were running another publicly traded company and we began to flatline. Our business was just like, there was a lot of fighting internally. We had about 500 employees. And, a board member came to me and said, look, I think, we need to find another CEO. We've got to replace you. So I called up a friend. He introduced me to a coach named Patrick Tien. He runs a company called Rhythm Systems. And we implemented a tremendous amount of systems into the company. We brought in goal setting, 3-year goal setting, 1 year, quarterly, 2 days of strategic planning, 88 days of execution.
Right. So this reminds me of Traction, EOS, Gino Wickman, Entrepreneur.
Yes.
Have you heard of that or no?
Yes, absolutely. And I'm a big fan of his. I'm a big fan of Vern Harnish's.
Yeah.
And I'm a big fan of Patrick Tien's. They're all pretty much very similar. I like Patrick's because he tends to lean more on goal setting up goals, and he's got a platform. So it allows you to institutionalize the systems to scale. And we talk a lot about that in the book in the scale section.
Interesting.
About what you need to do to help scale your business. But remember, the number one thing holding you back is yourself. And when an entrepreneur can come to the realization that they can step back or they can trust others to run divisions, I call it delegating responsibilities, not tasks. Like, in start, it's all about the entrepreneur doing everything and weaning the baby. But then when we get into scale, it's all about delegating those responsibilities so that 3 o'clock in the morning, you're not thinking about all those things. You got somebody else up at 3 o'clock in the morning worried about those areas of your business.
And so then does that allow you then to still help with the business and the things you're good at? Or do you, when this board member told you that, did you just fully step away?
No, I embraced all of these systems, all the things that we needed to bring in to scale the company. Our revenue within 3 years tripled.
Oh, I love that.
And we sold the company. It was publicly traded.
Let's go. I love that. 3 times. Let's go. You're amping me up right now.
Oh, you're going to like this even better. We sold the company for 17 times EBITDA to a Fortune 500 company 3 years later. And I remember sitting at the board table with 20 board executives, and they're all looking around, and we're doing the presentation about all these systems and goal setting and the strategic planning and all this kind of stuff. And he looks at the board, he looks at the presentation, he points his finger at the other 20 people in the room, and he says, you know what? That's what I'm talking about. That's what we need to bring to our company, the kind of culture we need to bring. But when
you're saying that kind of culture, what do you mean by that?
The culture of planning, the culture of execution.
Yep.
The culture
of results,
of
goal setting.
Yes. Goal setting.
Yeah. I didn't know
culture, and it was institutionalized. Yeah.
Yeah. I didn't know what you were going with it, because we were talking about you taking a step back, but, and I was asking like what your role changed to, and your role changed to helping to implement the systems, so to speak.
Well, my first role was to find great leaders.
Yeah, once
We have a great chapter in the book on that.
Okay.
Once you've got the great leaders in place,
Got it.
okay,
Yep.
and you've got all the systems in place, it's scale time.
Got it.
And we did that. And there are other aspects of scaling we haven't touched upon. For instance, your story sometimes needs to change. Think about Amazon. It used to just be a bookseller, right? And he sold books from his garage, and then he eventually expanded his story. In the book, we talk about a concept called an X factor. This is something unique and different that you have that no one else has. It started with Jim Collins, and then again, Vern Harnish really did a lot of work on this area as well, even Patrick Tian. And it's really about solving a bottleneck in the industry. So think about Domino's Pizza, 30 minutes or free. Think about National Car Rental. If you've ever rent from National, you just show up at the lot, get in the car and go, right? So they were solving a problem, a bottleneck in the industry, and they were offering something unique and different that no one else could. It took us 6 years at Hostopia to figure that out. Once we figured that out, in our case, it was 100% migration guarantee. We won the Earthlink contract of 80,000 websites and millions of email addresses. Meanwhile, only 24 hours before that, we were told we were going to lose that contract. But we flew into Atlanta and we pitched them the idea of a 100% migration guarantee. See, we had become the best in the world at doing migrations. And we recognized that the buyer was not Earthlink or a telecom. The buyer was a mid-level executive that was worried about being fired. And we won that deal, and then we won AT&T, Vodafone, British Telecom, all
because you
freaking domino.
Because you migrated the stuff over.
Because we had something that none of our competitors had. We were the best in the world at migration.
Yep.
And then we came up with what I call a nearly unbearable brand promise. Nearly unbearable, which was a 100% migration guarantee where we would pay $350 per website that we lost on a migration. And the number one reason that person chose us over the others is because they were worried about their job. Because in tech world, migrations are scary, and a lot of people can lose their job over it. So we solved that problem, and we won the marketplace. Don't get me wrong; we had a great platform. We had other things as well, but that's what really made us unique. And our competitor was owned by NTT.
I didn't understand your
it's a big company.
Your guarantee. The $350 was what? Is like every day the site that migrate, you got to owe that to the.
So if we lost one website on a migration, we would pay the company $350.
If someone transferred their website over to you and they only have one website, when $350.
Yeah, so we were migrating 80,000.
That's what I thought.
Websites for Earthlink.
Okay, got it.
So we lost 1,000 websites. Oh my gosh, and it changed it was radical. It was very hard to do.
But you get what I was saying.
We had to radically change our business.
If we have one website and we migrate and only pay us $350, that wouldn't be good. But,
no, Hostopia, we sold to telecoms, so we would, we sold to the telecoms, so we do tens of thousands, hundreds of thousands of websites and emails.
And your biggest competitor was NTT back then?
Vario, which was owned by NTT. I don't know if you remember Vario. $5.6 billion transaction. It's whatever. And they were our biggest competitor, but they just couldn't keep up. They just couldn't keep up with the technology, and they didn't have what we had. Eventually, most of the sales staff ended up coming to work for us.
Got it. A lot of stuff. We just, in the first, I don't think it's been 19 minutes, but that's what Aaron just put on the screen. But in the first 19 minutes, I think it was less than that, but maybe he's right. We've got a lot of stuff that just happened there. So that was amazing. But I'm about to skip to something else. So you and your partners launched new companies. So you got the startup club, but then you have an incubator, Escape Club, a vacation rental company, Hip Optical, fashion forward eyewear company, Pome AI, Paw Designer, dog products company. So tell me more. What's this mean? Are these?
Yeah. So I mean, we've been successful at starting, scaling, exiting many companies. There was one failure we'll talk about in a few minutes. We should talk about that one. We promised we would do that.
Oh yes.
But we
wait, only one failure?
We've been successful. There's one. Well, it was $1 billion failure. So it was a big one.
Got it.
All right. Yeah. So we'll talk about that one in a few minutes. But now I'm involved in 20 companies. I'm a significant investor in 10 companies. I'm CEO of none of the companies. You'd call, I guess, we'd liken it to a family office. And I think our biggest, it's either Geeks for Less, which we have 800 programmers in Ukraine, or Paw.com, which is an e-commerce dog products company. Both of them are pretty substantial. for startups, and they've been around for many years. And I'm not CEO of either of them.
Did you start?
And that's where I've changed. So I've transformed. I'm into repeat mode now, right? I'm into take the formula, take the systems, take what you've learned and implement them at all these other companies and help them scale, but don't get pulled in as CEO anymore. I did that for 30 years.
Did you start any of these other ones, Geeks for Less or Hip Optical,
yes.
or any of these?
So Geeks for Less, yes. Hip Optical, I was the first shareholder. Paw.com was the first shareholder. Unfortunately, and I became the largest shareholder of Paw.com. Unfortunately, we had to make some changes at the executive team. So over time, sometimes it happens. You do really well, and sometimes you have to make changes at the top, and we've made those changes at the top, and the company's doing very well today.
Now, you mentioned that you're in this repeat mode and you're not the CEO of any of these things. So how do you get the rhythm of the business? Is it the level 10 meeting each week? That's a traction term. And by the way, traction I think is good. There's things I don't like about it, but overall, you can level 10 meetings, having your weekly goals, and then fostering up any issues. So that way people don't ever like 3 weeks later, hey, we had this issue with this client. Then no one knows about it. Then it's in the weekly meeting or it's in a daily. But right, like that's where, is that how you stay abreast, or how do you go about it?
So my role is really to be a coach and also to join the strategic planning sessions. We love to do 2 days of strategic planning, 88 days of execution at these companies. Now, sometimes it'll vary between companies. I'll lean in sometimes I'll lean in a different way based on who's running the company. For instance, my wife owns a school, and she doesn't want me involved in it. So, I've tried, but other than getting her to read the book, she's on her own just running the school.
She just wants you to go out of town and give her peace and quiet.
Yeah, I got this covered. But you know what?
Yeah.
Her failing is that she delegates tasks, not responsibilities. She has 16 employees, and she's up at 3:00 in the morning every night because she really hasn't come up with that concept of delegating responsibilities versus tasks.
Got it.
And that's a breakthrough for any entrepreneur.
That's interesting.
Even if you're not giving up your CEO-ship, it's just such a huge breakthrough. It's such a huge mental challenge to get over this idea that you can trust others to run areas of responsibility.
Yeah, and the truth is, like, going from 0 to 1. So I started Benzinga in my basement with nothing and whatever, and then got it to a size. And the same person that got 0 to 1 or 1 to 2 isn't necessarily the same person that's going to get it from 3 to 6. It's a different rhythm, and I see that, and I think the part that is like, now I think Benzinga is still a startup. The financial media part, that is a startup in the sense it's co-founded every day. I founded Benzinga, but I do say I'm a co-founder most often because I think these companies are founded every day by the people that walk into the room, because I ain't doing much, and others are. But to your point that you just said, you delegate responsibilities, not tasks. So by that, will you give us an example of what you mean and what this part your wife should listen to?
No, absolutely. And the example really is the school, because in the particular case school, she's responsible for the building, the infrastructure, the hiring, the teachers, the parents, all that stuff. Now she has people that do those things, right? She has resources. She has runs a successful school, but she doesn't hand over that responsibility. When you begin to think about handing over responsibility, let's just say it's sales, for instance, you hand over sales to someone else. This doesn't mean you're not going to help them out. This doesn't mean you're not going to coach them, but this does mean you're not going to be worried about sales at 3:00 in the morning anymore. Someone else has got that covered, or someone else has got IT covered, or someone else has got infrastructure, or someone else has got SOPs covered. And you can begin to break down your business into multiple areas and say, okay, right now I'm responsible for all of them, but let's just start taking piece by piece and assigning responsibility to individuals or others who can do this. And ideally, if we want to scale our business, we're going to want to hire leaders. In the book, we talk a lot about personality profiles of leaders, and you're going to want the right type of personality profile for that particular position.
Okay. So the book, again, we're here with Colin Campbell. If you're listening, Start, Scale, Exit, Repeat. It's a #1 bestseller on Amazon. He's had billions of dollars in exits and made a lot of changes over time. So one of the things you mentioned, you said SOP. So strategic operating? Like, what's your SOP?
Standard operating procedures,
Yep.
just procedures, just
Yep.
writing out procedures, right? Part of the systems aspect of it, yeah.
Well, then you said 2 days of strategic planning and 88 days of execution. Does 88 days of execution mean, like, are you including weekends, or is it 88 days? Like, how do you consider that?
Obviously, I'd be including weekends on that, but the idea, the concept behind that is obviously it would include weekends. It's a 90-day period.
Yeah,
for the quarter,
yeah, of
right?
course. Okay,
Right.
I just wanted to. I didn't know if you were extending it. Okay, got it. Yeah, okay.
Yeah. And the key point, relate to that is when you have a startup, you're in sort of this chaos phase, and it works when you're small. But as you begin to scale, you can actually spend a lot of time doing strategic planning on a daily basis, going to lunch. This person's not involved, that person's not involved. When you bring your executive team together for 2 days, it can make a huge difference because you're now defining it. And then you're focused on the execution of it, and you're going to track those goals. And then when someone hits in Patrick Tian's case, rhythm system, he has a red, yellow, green. So if someone hits a yellow or a red, then the team can help jump in and help.
Yeah, I love red, yellow, green, and that's Patrick Ting. He has rhythms. Yeah, I love red, yellow, green. Now for Geeks for Less, you're still an owner of that. You guys are still operating it, correct?
That's correct. Yeah, we have 800 people, mostly in Ukraine. Coders. We've survived the war, and in fact, have done rather well. We expanded to Poland and to the U.S. and to Canada as well. And a lot of our developers have actually moved to those countries.
So you guys have business development people probably in the U.S. that get clients, and then they pitch it, and then they build a website, or then they do the maintenance, and they do the back end. They become on retainer type businesses, right?
Yeah, it's more Geeks for Less, like direct control and ownership of the programmers.
Okay.
So typically we'd have companies hire first for 5-10 programmers. And there's a direct relationship. So you'll generally have some programmers locally, or you'll have some IT staff, and they'll manage them offshore. Do
they ever want to bypass you, the client, and go directly?
Sometimes that occurs. Yeah. No, but they're working directly with the client. But when you're talking about infrastructure in foreign countries and whatnot like that, it's not.
Well, that's what I was getting at. So they work directly with the developers. But the value you guys bring in is helping to find the developers, or helping with the payroll? Yeah. Like, which part?
Finding the developers, payroll, infrastructure, security, all of the above.
Okay. And so my question to you is, let's say that the Geeks for Less may not be the best example, but let's say you see something wrong on the site. There's a mistake. The date's wrong, or you're not sure if it's wrong, actually. Okay. And I know that's like a micro thing. Who do you go to? Do you send a Slack message or an email to the web team at Geeks for Less, or do you send it to the CEO? Because you don't want to give the CEO some minute task. Hey, how do you handle that?
And that does depend a little bit on the who you're working with. I know in the case of Geeks for Less, the CEO would want me just to let him know, or one of the other leaders that he's introduced me to. With PAW, I tend to go more direct to the people. So I think sometimes it's just different for each company. There's no set rule.
Yeah, because today I had an item that the item was correct. The item was correct, but I was like, maybe this could be incorrect. But I was driving. I'm like, if this is incorrect, this could be bad because it's like a data thing, and it wasn't. It was right. I'm like, okay, so do I bore the CEO with this thing because it's not going to move the company forward? We'd get a little negative thing if it was wrong, and I want to save it before it's wrong. And so that's sometimes a struggle because it's you don't want to give your CEO hey, because we write 200 articles a day, right? And 1,000 headlines. If I read every article we wrote, I would send him stuff all day because no matter what, any publication is going to have mistakes. And so that part I wrestle with, because then here's the kicker. I don't want me to write directly to someone on a lower level that I never write to, because then they think it's the most important, they think, oh my God, what's going, you know what I mean? And so that you have to, it's a hard balance. I just want to be like everyone else and not be thought of and that's what we should be, because we're all at the end of the day just trying to figure things out in this world. And but yeah, so that's why I asked you that question. How you get, you said, Paul, you go directly to the people, but it depends how the company is what you're saying.
Yeah, when I say people too, I generally go to whoever's responsible for that area.
Yeah.
So if you have a content editor who's
That's
responsible, you could just go directly.
That's what I did.
I mean, just let them know.
And that's what I did.
Yeah.
And he answered, and it was quick. That's what I did. But I just wondered how you handled it. All right. Now we talked about 2 days of strategic planning, 88 days of execution. About you're in the repeat stage. You're not the CEO of any company, but you were involved in a failure, and you said it was of the B proportion. So let's hit that up again. We're Colin Campbell, author of Start, Scale, Exit, Repeat. Go ahead. Let's hear this failure story.
So, right out of college, jumped into something called the internet, called Internet Direct.
What year?
Was the company that it was 93, and this was the company that bought the Two Cows, the website, and then spun it out as Two Cows Internet, different company. And so we jumped into that, became the largest ISP in Canada, fastest growing company in Canada. In fact, we were the 7th fastest growing company. I think it was 97 or 98. It was 97. And then 98, we're the number 1 fastest growing company in Canada. We were a publicly traded company, front page of Profit magazine, which is sort of like the Inc. magazine in Canada. And we decided to sell to a cable company called Look Communications in late mid 1999. But we agreed to an 18-month lockup of our stock. Well, do you remember what happened in March of 2000? Yep. The stock market Nasdaq went from 5,000 to 4,000 after a judge announced they were going to break up Microsoft. So the people that were running the company at the time, I was no longer the president. It was run by a president, a telecom executive. And they decided that, it's too risky. Let's wait till the market bounces back. Well, if you know anything about the time, the Nasdaq fell to 1,200.
Wait. What was too risky at the 4,000 to sell it?
It was just the market's going to bounce back. It's too expensive to raise the money now. Let's just wait till the market comes back, and then we'll do the $50 million offering.
Yep.
And anyway, fast forward 18 months later, and the stock that was trading at $19 a share, I ended up selling for 6 cents a share, and I had 13% of this company worth over $1 billion at the time. I'm 29 years old. Insanity. And, I spent 10 years with my partners and I building this company and literally 6 weeks screwing it up. And there are 2 major things we learned from that. One, we learned that when you're going to sell your company, liquidity or control. And I have a chapter in the book on this one. I'm a very big believer in this, that there's a lot of deals that can go bad after you exit if you haven't received cash or liquidity. And so nowadays, I've always been preaching.
You mean you just said cash or liquidity? Do you mean liquidity or control?
Yeah.
Okay.
So liquidity or control. You need liquidity or control. You need cash or free trading stock. I mean, real free trading stock.
Okay.
Right. Or control. You maintain control. You can sell parts of your company off, but you maintain control. And when you have that in place, then you can at least maneuver and be the one making the decisions instead of sitting in the back seat trying to fight a CEO who wouldn't listen to you. And the second thing I learned is that bad things do happen. The .com crash happens. If you go back to 2021, not too long ago, do you remember $500,000 Bored Apes, cartoon pictures, NFTs? Do you remember GameStop out of control? Do you remember the IPOs, how many IPOs were occurring? And also you had
SPACs.
SPACs, thank you. I was looking for the term.
Yep.
You had all these SPACs blowing up. Things were out of control. And that's when I usually say exit stage left, when things are good. And thankfully, we exited a big company called .club, which was an alternative to .com, .net. We sold that to GoDaddy right at that time. Fast forward a year later, high inflation, high interest rates, tech crash, crypto crash, no IPOs. In fact, the IPO window has been essentially closed since 2022. To even up to date, the present. And in the book, we talk about cycles, and 50% of your value of your company is when you sell your company. And so we want to look at those cycles in business and try to position to sell correctly at the right time. See, this book, Start, Scale, Exit, Repeat, this book started because I was asked to speak at MIT to an entrepreneurs organization. It was the Masters of Entrepreneurship program run by Vern Harnish. And they asked me because they wanted to understand how I could start, scale, exit, repeats over and over again and get the timing right. Well, let me tell you something. When you lose, you lose $100 million at the age of 29, you're a little bit sensitive to that. I'll tell you this, the startup failures are the scars of our past that guide us through new ventures. And that scar, it's there. I mean, I have it. And it wasn't just me. Every one of my team were millionaires on paper, and they all lost it all because I screwed it up.
Well, not totally. You didn't totally screw it up, right? Like you sold.
Well, my brother and I can throw my brother under the bus too if you want.
No,
but it was our responsibility.
But didn't you sell? Didn't you guys end up selling to someone else? But then they didn't do that offering to give you guys liquidity.
No, so we were publicly traded.
Yeah.
We sold to a cable company.
That's what I thought. Yeah.
We were in that deal. We agreed to an 18-month lockup.
Yeah, that was the mistake.
That was the mistake.
Now,
liquidity. We didn't have control, and we didn't have liquidity.
Now, one more question on that, and I'm sure I don't know. Maybe you haven't. Remember what Mark Cuban did with broadcast.com when he sold to Yahoo? He built some hedges in, like where his upside was limited and this or whatever. Could that have been something you guys could have done with your stock of the Canadian stock? I don't know. I'm just curious.
It's so funny you say that because I often look back and said Mark Cuban and I were almost at a similar point in time when we sold, because I'd already sold 2 cows and I was selling. And ironically, he actually invested in 2 cows at one point. It's just very ironic. Anyway, but we screwed that exit up, and I got to get over it. Absolutely. When you're selling a company, you want to get liquidity or control. You want to make certain that you're getting paid out. Even if you're not getting paid out 100%, you want to make certain that you're getting a substantial position out of your company if you're losing control. And that's a key. That's the key behind the book. The book really should have been titled "Start, Scale, Exit, Take Some Money Off the Table, Repeat." And that's because bad things do happen. And we are entrepreneurs. We're not just CEOs of one company, or you're not just a founder of Benzinga. You're an entrepreneur, and entrepreneurship is a trade like any other trade, and we need to hone that trade. And when we do that, we can increase our chances of success when we start that next business, or when we scale the next business, or we can position ourselves more correctly when we exit that business. And that's what the book's all about.
Yeah. I mean, and when I was in college, I had startups that were getting traction, and then I got bored of them. And I'm like, all right, I'm going to go start a cell phone company that pays. You can use your phone to pay for stuff and open your hotel room door. When I had stuff that was actually working in Borders at a textbook site. And then I just but that was the scars of not following through with stuff. And that changed how I treat stuff now. But you just made me think of something else. So start, scale, exit, repeat. You said take some money off and repeat. But there was something you just had me think about. Oh, yeah. You're entrepreneurs. You're finding solutions to problems, coming up with ideas. So would you, with what you do now, is this like, are you still looking for new ideas to start? Or you're like, okay, I have enough. I'm just going to focus on, the stuff I have in the current, portfolio.
Yeah. So for me personally, and probably a lot of family offices, private equity firms, my cup is full. I've had to go back on 2 or 3 of the companies and back fund them because, the interest rates have been very high, very, very,
Yep.
Some of the carrying costs have been much higher. So I'm in a position right now where I was talking with my wife about this. I'm not investing in new companies, but I'm investing in my portfolio.
Got it. Okay.
Of companies. So I'm double downing. I'm double downing on the ones that I believe are going to take off.
Yep.
And we have a new company called Benzinga, which is an AI company. Been working on it for 2 years. It's coming out this month. That's one that we're pretty optimistic. It's basically a Canva for e-commerce companies. It's designed just for e-commerce companies.
Like a charge fee or what do you mean?
Think of Canva, but focused just on e-commerce companies, right? But it does because we API into all like Klaviyo and Shopify, and it's designed around Shopify.
Got it. And where do you get all your do you take developers from Geeks for Less? Like for that, that's a tech company right there. So do you find someone that wants to build something like that, or you wanted to build it and then you're like, hey, I need to find developers?
Developers, it's not hard to get.
No, I get it.
You're only limited to your imagination. So
I get it. But on this idea, like, did someone come to you and say, hey, I have this idea to do, or did you come with this idea?
Yeah. Okay. So this is not a company I started. This is a company somebody else started. They came to me, pitched the idea, and I said, okay, I'll do. My brother and I both invest in it, and it's 2 years, almost 2 years this November before it's launched, and we're getting really frustrated, to be honest with you.
Okay.
It's taken too long to launch.
Okay, got it.
But it's a platform company. It's my favorite type of company. Those recurring revenue platform companies, digital platforms.
Back end, and where I like to negotiate on the fees we pay, because it's SaaS. Like you said, a platform company. Like, I
love it.
I love those businesses. But going back, and by the way, I shouldn't be spending time negotiating those things. That's what I did back in the day. But anyway, going to one more question for you. You wrote this book. How long did it take you to write this book?
I'm glad you asked that question, because that session I went at MIT 10 years ago. That session, that's when the theories came together. To start, scale, exit, repeat, and under each area, there's the story, the people, the money, and the systems, and it's very different for each of those sections. And so that's where the theory started. That's where I presented it. And since then, I've been working on the plane. So it's been over 10 years. We interviewed over 200 people for the book. We had 6 full-time staff members in the last 2 years, really putting it together, working with Forbes to get it published. And it has received a number of accolades. It's won 12 awards. It's been #1 bestseller on Amazon in 13 categories. It's doing way better than we thought it could potentially do. And, a lot of people say they'll write a book and put it out there, a lot of business books, and they just don't get a lot of traction. Well, this book's continuing to get traction. We just got a deal with Hudson's and WH Smith for all the airports in the United States for the fall. So the momentum just keeps coming.
When you get a deal with Hudson's and WH Smith, did they call it like your publisher or what?
Yeah, so our publisher is Forbes Books, and they make a pitch. They'll make a pitch to it. And, first time we pitched, we didn't get it. They turned us down. So that was about 8 months ago. This time we pitched again, and they said,
That's
what,
awesome.
Your book's been doing really well. We want it.
Does that make you feel good? I mean, you made this book. You're working on it. You don't know if anyone's going to read it. Like, I'm going to write stuff. Maybe someone will read it. Who knows? Does that make you feel like, or are you just like, all right, I'm on to the next thing, or now I got to do volume 2? Like, where's your head at?
There's not around volume 2. Definitely not. It took 10 years to make this one.
Yeah.
I'm like, I got to focus on the 20 companies.
Yeah.
And I promised my wife I would start to reduce some of that, because it can be stressful. But it was a way of giving back, and a way of sharing the information that I had, the formula, the successes, the people we interviewed. We had some phenomenal people, like Vern Harnish, who runs Scaling Up, like Jeffrey Moore. I don't know if you're familiar with his work, from Crossing the Chasm and Inside the Tornado. But phenomenal books. I consider one of the top 10 business books. Just so excited to be able to interview him on our chapter 3, which is Catching the Wave, especially because we were able to talk a little bit about how to catch the AI wave, and and what's the formula, and what are the things you need to do. Because in all of those companies I talked to you about from the early 90s, there was a paradigm shift or a technology shift occurring, and we were able to take advantage of that or catch that wave. And there are literally probably hundreds of paradigm shifts or small regulatory shifts that are occurring, because that's where entrepreneurs have a bigger chance of succeeding. If you're going into a traditional business, like printing checks or something like that, your chances are 0 to none. Like you got nothing. But if you're going into something new, something different, something that there's been a regulatory or technological change, your opportunity of succeeding increases dramatically.
Yeah.
That's when I say enter the entrepreneur. We take the risk, and then we sell the company to the big companies down the road.
Yeah. The struggle I like, so in reading Start, Scale, Exit, Repeat, one of the biggest challenges, like, I think if you're in a startup and you're leading it or what have you, and you don't read this book, you're crazy, because there's so many gems. If you listen to this interview, there's so many different gems about how you scale it, how you exit it, how you get cash, or control, either way. But one of the biggest challenges that I find is, so say I have an idea for something. I want a website that just, makes me better pens. I don't know. You have to do it unless you find someone else to go lead it. You know what I mean? There's a clothing thing I want to do, and it's been in my head forever, and I just haven't done it. Part of it is because I don't necessarily want to be the day-to-day. I want someone else to go do it. And that's where the scrappiness of the entrepreneur comes in, where you have to go find someone in that space and go do that versus you going to do it. You know what I mean? Like, I don't know how Geeks for Less or how, paw.com got started, but is that one of the biggest challenges for an entrepreneur to scale themselves, to go find those leaders even before they're real companies? Do you find that as a challenge, or are you always the guy starting it and then you bring someone in after like 6 months when it's already developed?
Okay, in your clothing business, you got a story. It sounds like you have got a good story.
It's soft. Everything. Everyone likes soft materials. Okay, everyone likes it. So like I have this thing domain and everything's soft. The softest in the world. Yeah. So that I have the story, and yeah.
So you have the funding, or you can get the funding, and you know how to implement the systems. You understand traction or rhythm system, whatever it is.
Or Shopify.
The last piece that you need is people.
Right.
And that's the hardest of all of them, because how are you going to hire an entrepreneur? Because the best entrepreneurs are already running their own companies. Right. So that's what we talk about in the book. And a lot of the people running my companies are individuals who used to work for me, who are my leaders. Remember, I talked about this certain personality profile in leaders. That personality profile is, and if you follow the DISC methodology, requires dominance and some other significant trait. Right. So it's either dominance and influence if you want a sales guy. And I got one of my ex-employees, he became CEO of my last company. After he left that company, I brought him into another company. He's running that company today. And another is an individual who was our CTO, and he's running, he was CTO at the company. And then he eventually became CEO of an ad company, a digital ad company that we started in Toronto. So there's a lot of talent with people around you. And I track these A players. We talk about this in the book. I know I'm going so fast.
No, but it's great. Right? It's great.
You got me excited, right?
It's great.
But we talk about this in the book, and we track the A players through LinkedIn. I never hire back from companies that I've sold. I'm not going to cross that line. I believe there's ethical practices as well. But what I will do is I'll track them through LinkedIn, and more often than not, the entrepreneurial mindset, those who have entrepreneurial personalities, they tend to leave because they're just not happy. And I can't tell you how many times I've rehired people. I got one guy, he's working for Benzinga, and I think he started in 1993 with me. And over the years, he'll work, sell a company, and then leave it, and then we'll bring him back and sell a company. I talk about him in the book as well. It's pretty funny, but he's still in the company today.
So one thing I think that's interesting is you have like a good person from one of the companies and you bring them to the next company. Like, do you feel so you don't take them directly from a company that you have already and bring them to another company, or they have to go somewhere else first?
They have to go somewhere else first if I've sold it. There might be some rare occasions where I'll poach from my own company. But I want to caution that, as serial entrepreneurs, sometimes we can get a little too, well, I love this idea. We're following the laser beam or whatever it is. No, we've got to take care of our core first. You've got to make certain that your core business is doing very well. And you've hired the leaders, and you'll know when you're starting to get a little bored of your core business. You're starting to say, it's humming, it's making good money, it's growing, my team's doing everything. I just want to wait for a month or two. Actually, the business improved since I left. Now we can begin to think about what are some businesses we can launch within the context of our current company. Because when you're in the thick of it, you see ideas everywhere, especially in a day and age where you got AI out there.
Yeah.
I mean, ideas are just, constantly. So you're in the middle of a business. Like we're in paw.com, that Hip Optical, the e-commerce businesses. It was one of the e-commerce guys who'd run e-commerce businesses for years who pitched the idea of doing this AI platform for e-commerce. So more often than not, you'll get an idea from your existing. When we were at Internet Direct, we started Geeks for Less. When we were at Internet Direct, we had a call from a telecom named SaskTel, and they said, "Can we license your hosting platform?" Ding, ding, ding. We went and built another company, hosting platform, and then we sold that to the telecoms.
So when we were there, you built another company to white label to the telecoms.
Correct, including ourselves, by the way, including our own company, right? And then when we were running Hostopia, I did a study of new domain extensions, and .club was just one I loved. Years later, after I had left the Fortune 500 company, stopped working for them, ICANN opened up the new domain extensions. And I went back to them and says, hey, guys, I would like to do this. Is there an issue with this? And they said, no, it's too risky. You go ahead, you do it. So I registered .club, got the domain extension, sold 1 million domain names, and sold that to GoDaddy in 2021.
Wait, you just got .club for free?
No, $12 million. We raised $12 million. We won it in an auction. It was a battle. It was a fight. And we hired a team. It was a micro global brand. We went to 50 countries. Got into China, got approved in China, went to China 12 times.
Wow,
it was
that's a hustle.
Tough business.
That's a hustle. So yeah,
it was a hustle.
So that's a hustle. Yeah,
but it's the same type of business you and I love, which is those SaaS, those recurring revenue models, right? You sell one domain for $10 a year, 1 million domains, and it's 90% profit.
Yep.
It's a great business.
I'm paying GoDaddy.
But getting into that position could be tough.
I'm paying GoDaddy a lot of money in my domain. I used to have them at all these different places that were cheaper, iPowerWeb, this, and I recently consolidated most of my domains to GoDaddy, which I know I'm paying 90% profit. It's crazy what I'm paying. I mean,
how many domains do you have?
It's not a crazy amount, maybe 150.
Yeah, see, you're a typical serial entrepreneur that's got an addiction. Every time I register a domain name, it's like a blackjack player to blackjack.
I own domains like Corporate Watchdog. Like, that's a good domain. And like, I've never done anything with it, you know? And, or I have other, you know, like I used to own like Golf Help and like Words and just let some expire. I was dead set on getting my last name Raz, R-A-Z, just that, instead of buying like these crazy names like in 97, or 90. No, that was 95. And I never got Raz. And then, I have like, you know, some other random good domains that I just pay a retainer on and do nothing with.
And you know, a domain matters a lot. We paid a lot for paw.com, PAW.com.
Yeah, you must pay.
It was a big name,
millions.
But our revenue doubled the year after we got the name.
My sister's a vet.
We have lower advertising costs because we're more credible because we got that name. People can remember it. I could be on a podcast and I could say, hey, check out our products on paw.com.
Yeah, my sister's
Of course, you have to do everything else right, too. You can't just have a name. You got to do everything else right.
Yeah, my sister's a veterinarian, and I'm trying to like do some SaaS type thing as a veterinarian. But I think now she might be, I think her and her husband said they may be doing something. I forget what the whole thing is, but there was something for veterinarian SaaS. But anyways, yeah, paw.com is right there. I mean, you guys can sell products, but you guys can make money on SaaS. Like you guys on paw, like if it's like, you know, 1 hour call a month with a therapist for dogs. I don't know. There must be something.
We haven't cracked that. We tried. We had 100-year supply of shampoo. So it doesn't always work. You would think, because we're known for design and decor. We invent products at paw.com. Memory foam dog rugs, waterproof blankets, car seats, cooling blankets. We have all these really cool products, but we're not known as a company that sells shampoo. So when we went into it, we ended up completely failing, and we ended up just destroying it eventually.
Why don't you sell paw.com?
It's not the right time to sell paw.com. I mean, look at the market. You know, we're going to know when it's the right time when we start to see. The number one indicator I use is a number of IPOs per year. Okay, the number of IPOs are almost all-time low. This is not the time to be selling companies. This is the time to build companies. This is the time to survive these interest rates, whatever it is, and also expand distribution. Just it's time to build. That's essentially. There's going to come a time, 2 years from now, 3 years from now, when the market's hot, things are good, and we can find a buyer. And we're not going to sell the company to private equity. They tend to focus a lot on cash flow buyers. We're probably not going to sell it to a competitor. But even though competitors are a little better than private equity because there are some cost savings, we're going to sell it to a strategic buyer. And we talk a lot about that in the book.
Strategic buyer.
The best way to maximize.
Like a strategic buyer would be like someone who is maybe like a pet food company and they want to have a...
If you want to surmise, like in this particular case, we have 1 million customers and we have great products. Take a PetSmart, and they all of a sudden can sell all our products throughout all of their distribution.
But PetSmart's is a competitor,
and they can. Yeah, Chew is a competitor, but we sell on both of them today.
I know, but I thought you said you wouldn't sell to a competitor.
No, it's okay. Slow down. GoDaddy was a competitor to us as well, if you think about it.
100%.
And they did benefit by, I'm glad you brought up, they did benefit by reducing the expenses, because most of the people on our team did not go over to GoDaddy. So that was a big benefit. And that's key, because then you get a higher valuation. But more importantly, they were strategic because they have more distribution than us.
Got it.
Right? So when they take .club and they sell that to their customers, they're going to look at that, their model, and their model is going to tell them they can make a lot more money from .club than we can make from .club. When we sold Hostopia for 17 times EBITDA, the company that we sold to had millions of small businesses. So they looked at their business model and said, if we take their technology, we plug it into our small businesses, we can get an additional lift. They're not going to pay you the full lift.
Got it.
But they'll pay you somewhere in between.
So understood. And when I went, because I was like, you said strategics and then you said competitors, but a competitor would be more someone like similar size, but like a strategic's like a PetSmart, which, they have more distribution. They have these things, they get your products and they
Correct.
have, it's no brainer. And then to your point is they can cut costs and you can have a great exit. No, that's, and private equity, you said no to because they're more focused on the cash flow.
I get the calls all the time. All the time I get the calls, but they are generally highly leveraged, interest rate sensitive. If they're looking at, you're paying 8 or 9% interest rate right now, they're going to want to make 16 or 17%, at least on their returns. And your company, if it's e-commerce, you're selling for 3-4 times earnings, right? There's no strategic value. If we can get a company to see the strategic value, we might be able to push that up to 8 or 9 times earnings for an e-commerce company. For SaaS companies, it goes much higher than that.
Okay. And my final question from the author of Start, Scale, Exit, Repeat, Colin Campbell. I had more questions to get to, but this one, do you typically hire a banker when you go through the process?
Okay, it depends. Sometimes we do. We spend millions of dollars on bankers. And sometimes, but I will say, whether you hire a banker or not, when it comes to closing a transaction, selling a company, developing a trust with the decision maker on the other side is critically important. Despite RBC telling me not to do this because we were struggling to get our IPO out, I picked up the phone and called the lead institution and talked to him. And I asked him, what's going to take this deal? Okay. He says, Colin, it's a great company. You're just overpriced. I said, okay, tell me what's going to take the deal. He says, okay, come in at $6. So I said, okay, we'll do it. Once I closed him, we closed everyone else. It was oversold, But we developed a trust. Same thing at Hostopia. We had RBC again selling to Hostopia, but I developed a trust with the CEO of Deluxe, which was the company we sold to. And at .club, I didn't have a banker, but I'd known the president of the domain registry for 3 years. He came up to me in a trade show. I met him at trade shows multiple times. He tried to buy the company 3 or 4 times. And eventually, he believed in the strategic value and gave us the valuation we were looking for.
That's great. And by the way, I know you discussed this in the book. So Start, Scale, Exit, Repeat. The last final question: what advice would you give your 20-year-old self? And that's promised you. I promise you, no more Raz Report. We're done. We're over limits. Your interview, the content you have. The information you have is unbelievable. They've waved me down like 6 times, and I pretend that I don't see them. So, what advice would you give your 20-year-old self? That's the last question.
Believe in yourself. I kept thinking I needed to have other business partners and they knew how to do sales better, this, that. And, I just didn't really believe in myself in the early 90s. And it took me a while to realize, I had the right instincts, follow that, believe in that. And then when you are successful, take some money off the table, exit and repeat.
Love it. You guys get his book. Don't wait. We'll send it to you when we get this published. Colin Campbell, Start, Scale, Exit, Repeat. If you're looking to make money in a startup and you don't read this book, you're doing yourself a disservice. So thank you for coming on.
Thank you.